Welcome to Lesson 3. Today we're going to talk about everyone's favorite thing, taxes. I'll also share some tips for how to stay on Uncle Sam's good side. The 4 big tax topics I'm going to cover today are sales tax, the difference between self-employment tax and income tax, calculating and paying quarterly estimated taxes, and preparing to file your annual taxes. We'll get started with sales tax. Even if you don't sell products, you'll want to understand sales tax in case you do sell products someday or in case you sell services in a state that charges sales tax on those services. Sales tax can be a real pain because every state has their own set of rules. The first thing you need to do is figure out whether your state has a statewide sales tax. There are only 5 states that don't. Download the Lesson 3 guide to find your state and which type of sales tax you'll use. There are 3 options explained in the guide. Destination-based sales tax, which is where you charge sales tax based on the final destination of the product, which is most likely your customer's mailing address. Origin-based sales tax, which is where you charge sales tax based on where you are physically located when you send the product. And if your business is in California, it's a hybrid destination-based and origin-based sales tax state. Once you know how you'll be calculating sales tax, you'll need to submit a sales tax application to the state or states where you operate. Most states have an online application you can fill out. Once you've done this, you'll receive your state sales tax ID number, information on how to pay the sales tax, and instructions for how often you have to pay. Put those due dates on your calendar and set reminders so you don't forget. This way you can avoid late fees. If you plan to physically go into other states to sell your products, like at craft fairs or markets, or if you sell a significant amount in another state, you may have what's called nexus in that state. Check with that state to see if you need to register for sales tax there. If you have a high volume of sales in a state other than the one where your business is located, I recommend plugging your sales totals into our Economic Nexus tool linked beside the lesson guide. If you meet the sales threshold shown with this tool, then you'll be required to register with that state's tax department and collect and remit sales tax in that state, even if you never physically operate out of it. Make sure you keep accurate and detailed records of your sales tax transactions. Our second big tax topic today is the difference between self-employment tax and income tax. This is often confusing to clients. The self-employment tax is actually made up of 2 smaller taxes, Social Security tax and Medicare tax. When you're employed by an employer, they actually pay half of these taxes for you. When you're self-employed, the IRS allows a 50% deduction of the total self-employment tax you're assessed. This doesn't reduce your tax 50%, but it does reduce your overall taxable income. On the other hand, income tax is the tax taken out of your overall income for the year. The rate depends on what income tax bracket you fall in and ranges from 10% to 37%. Okay, now that you have an understanding about income and self-employment taxes, let's go over how to calculate and pay quarterly estimated taxes for both of those. The first thing I want to mention is that these payments aren't required. Even if you never pay quarterly estimated taxes, the worst thing that will happen is that you may be assessed penalties and interest on your annual federal return if you owe more than $1,000. For your state return, most states operate similarly and have a $500 threshold before the underpayment penalties and interest start to kick in. Most people do pay quarterly taxes, however, because they want to avoid making one giant payment at tax time. I suggest setting up a separate bank account where you keep the tax money you owe out of sight so you don't accidentally spend it. There are 3 methods for calculating your quarterly estimated taxes. You can find the detailed steps for each method on the quarterly estimated tax worksheet in our Lesson 3 guide. The first 2 methods shown, the safe harbor and percentage of net income methods, are easier to calculate. The third method, which uses an IRS worksheet, will give you the most accurate amount, but it's rather tedious to complete. Once you've come up with your estimated payments, you can mail in a check with a paper voucher or you can pay electronically at irs.gov/payments. If you pay electronically, be sure the person shown first on your tax return is the person whose social security number you enter when you make the payment. The due dates for quarterly tax payments don't fall evenly throughout the year, so make sure you put these dates on your calendar as well. The last big topic we're going to discuss is filing your annual tax return. There are generally two options here. You can hand everything over to an accountant, or you can do them yourself. If you hand them off to your accountant, here's the basic list of what they'll need from you for the business taxes: an income statement, also known as a profit and loss statement, any 1099s you've received, a list of any assets you've purchased or sold during the year, the total business miles or auto expenses, depending on which method you use, and a summary of your home office expenses. If you've ever thought about hiring an accountant, I always recommend talking with others from your industry to see who they work with and rave about. Once you've got some prospects, set up a time to chat to make sure you'd be a good fit for each other. Now it's checklist time. The checklist will walk you through preparations for the 4 big tax topics we've discussed today. I've also included a bonus worksheet for you to track your business assets. The next lesson, which you will have access to soon, is all about getting paid. We'll go over paying contractors, employees, and yourself.